interesting one. Beginner's Guide to Futures Calendars, Katie. You and I have traded our fair share of futures calendars. We're talking today about crude oil. Why are we talking about crude oil? Well, because one, it's up huge. And when a market is moving, Katie, in a volatile manner, that's when the calendars start to really kick in with opportunity. But two, we tend to speak about calendar spread trading in agricultures or energies, commodities in general, because that's where the opportunity is. When you talk about calendar spreads from a futures perspective in equities and interest rates, not a lot of opportunity just because there's not a lot affecting, this expiration versus that expiration in equities, whereas supply and demand really affects what crude oil looks like in March versus what it looks like in April. So with this crude being above $100 for the first time since 2014, some of the highest prices we've seen in over a decade for crude, Katie, I thought we would look at the calendars, which maybe you can do a quick powwow on what they are in general. It's just a matter of looking at two expirations of the same outright market, right?
Exactly. So that's like the one big difference between if you're talking about like an options trade versus a futures trade. Of course, both of those have different expirations, but the difference is in the options world, something like Apple, no matter what expiration you're going to, that at the money strike is based off of the current stock price. Whereas in the futures world, there are extra products that therefore have extra prices. So I know we're not talking about options today, but that is one of the main differences. And then because of that, because there are multiple contracts that have different prices, that presents an opportunity to us as traders to then utilize to determine, okay, are these relationships going to get closer together? Are they going to widen out farther? Are they going to do some type of, interesting inversion play? All of that is very useful information for when we're thinking about setting up calendar spreads in the future space.
Yeah, and this is a great time to talk about it because the recent volatility amid the Russian-Ukraine strife that's coming in the way of like, what will crude oil prices look like in the next couple of weeks versus a month from now versus a couple months from now causes great disparity in those prices. You've got a crude oil in March here, the SMO H22, Katie, priced at, this is as of yesterday's close, 106. And you've got just 1 month in the future, crude oil is $3 cheaper. These different prices for these different expirations, that's what causes there to be potential opportunity in trading futures calendars, especially when you look at here, Katie, the chart for this calendar spread. When times are relatively normal, Katie, and you know this, but maybe you can elaborate a little bit. When volatility is low and markets are where they usually are, calendar spreads usually are within, 10 cents, 20 cents, 30 cents, 50 cents of each other. But you see this huge move, and that's almost always synonymous with volatility and thus opportunity in the spread, right?
Exactly. And right now we're at SMO March 109, SMOJ 105. So we might even be like above like this 350 level that's on this chart. So even further extreme that can potentially be utilized. And obviously, like we always talk about opportunities at extremes, that also applies to relationships with calendars and, products that are the same product, just at different timeframes.
And the nice thing, and will be the closing note here, the nice takeaway is that calendars, you can see this like, a skyrocket. I probably want to sell that. It's no coincidence, Katie, that is happening with crude oil moving to all-time highs. Calendar spreads often are very highly correlated to the outright market and can be viewed as smaller versions of it. You look at that y-axis, Katie, this is a run-up in the last couple of weeks from a spread of about $100 or $150 to right now, like Katie says, $400, even higher than where this chart is showing. And so that is a move of just about $300 notionally. The same time frame, SMO, the outright contract, has moved over $1,000. And so this is a good way to get smaller and just trade crude oil like you normally would. If you want to be short crude oil on a smaller basis, you can sell SMO H22 and buy SMO J22. That calendar spread can be a good stand-in for the outright market itself.